Stablecoins are going to war. We're going to talk about Circle's IPO, Wyoming launching its own token, and Brian Armstrong calling out the US government. And all of this is in 1 week. This is crazy news. I'm Mick. That's Mike.
Stablecoin is right now the killer use case for crypto and blockchain rails. So it deserves its time in the sun and our airtime. No doubt about that.
And let's jump right into it. We're going to start off talking about Circle hiring JP Morgan and Citi to go public, targeting a $4 to $5 billion valuation. This marks this is a major moment for stablecoins and entering the traditional market, Mike.
Yeah, it's great news, right? The Circle has been at it for many years now. There's over 60 billion in circulation now, and again, this is just such a great use case for blockchain. And they've taken the path of regulation, right? They want to be very, very buttoned up. And obviously in the US that there was a huge demand for that, trustworthy and compliant. So and now we're going to see what the market thinks of the valuation of Circle, but they've obviously done a great job in ushering this era of stablecoins that we're in.
Something that is maybe not as great news is we're starting to see a little bit of a feud here between Brian Armstrong versus the Feds. You've got the Coinbase CEO who supports interest-bearing stablecoins, and he's arguing the government is unfairly favoring banks while suppressing crypto innovation. Ironically, Coinbase is co-issuing non-interest-bearing USDC. What do you make of this story, Mike?
So I think it shows what an OG and supporter Brian Armstrong is, but we'll get to that in a second. So a little bit of the background, there's this Genius Act, Stablecoin Act that's making its way through Congress, and one of the key points is that right as of now, the Genius Act does not allow stablecoin holders to receive interest, and they say it's because it may make these stablecoin securities. I think some people who are crypto natives believe that Congress is just trying to protect the banking industry, right? Banks obviously offer interest for account holders, checking and savings, but the interest is crap, right? For the most part. So Brian Armstrong, he wrote a Twitter article saying that stablecoin holders should be able to receive interest, similar to how banks offer interest to these account holders. He accuses the government of preferential treatment of banks. And yes, like you said, the interesting thing about this is that Coinbase and Circle both co-issue USDC. USDC is a non-interest-bearing stablecoin. So this essentially kind of opens the door a little bit for interest-bearing stablecoins to take away market share from USDC. But kind of in true kind of OG Brian Armstrong fashion, he's promoting free markets. He is, pushing this vision that Coinbase wants, financial success for everyone, and access for everyone across the world, right? So, and being able to earn interest on crypto is one of those. So, I think it's just an OG take at the kind of the expense of one of his lines of business to be able to push for something that really goes against his profitability. So but that's kind of the interesting angle that we see about this.
Wyoming is now entering the room. The state of Wyoming is launching its own fully backed stablecoin, WYST. Let's try to remember that one. It's testing on multiple chains, including Avalanche, Solana, Base, I believe, as well. And so it's using technology that we're all accustomed to, those that actually work in the industry and understand it. And this would be the very first public stablecoin, right, Mike?
Yep. So it'll be the first fiat-backed and fully reserved token issued by a public entity in the US. And it just kind of gets me thinking about where this is all gonna end up. What if Colorado launches their own stable? Right? What if I just drive across the state border? Is Wyoming going to accept Colorado coin? right? Are they integrated with Colorado chain? And then, let's say 50 US states. Is there, and then you kind of extend it out to like, what's kind of the surveillance mechanism, potential surveillance mechanism here, right? China has had its own CBDC for a while. Like, is the next step a CBDC? That kind of just circumvents all these, state borders, and then, what does that, how does that impact surveillance? It's, I don't think you need to necessarily get into the weeds of that now, but just like thinking about the whole vision of this and how this might all play out, it's, sounds kind of, I don't want to be a skeptic, but like, it sounds bullish now, like, but, in the long term, might it end up into something that, we have been trying to avoid the entire time?
I think that there's room for multiple stablecoins. I actually had a great conversation with the co-founder of Harbor.fi. He's building a bridge between banking and self-custody wallets. Actually, a very good episode. Highly recommend checking it out. But on that episode, we talked about the future of stablecoins, and in his humble opinion, he thinks that a lot of these stablecoins, you're not even going to know which one you're using. Everything's just going to run in the background. So I think maybe there's a place for everything, and it doesn't have to be one of those things where one dominates more than the other. There could be a place, as long as they go through proper regulation, of course, there could be room for all of them, including the decentralized stablecoins, which I know we've kind of been a little bit like, ooh, that's a red flag, for obvious reasons. But I think that there's still room for different types to be in play.
No, I totally agree. And that's one of the things that I love about stablecoins is that you've got this whole spectrum. You've got USDC playing in this highly regulated, super compliant end of the spectrum. And then you've got the decentralized stablecoins. And you've got DePIN, and then you've got some other ones that are more decentralized. And there's obviously there's yield bearing stablecoins, but like, again, it goes back to this debate that we keep having about institutional adoption of crypto. We keep coming back to it, and maybe some of our viewers are like, "Oh, stop talking about that." But like, what are the possible repercussions of institutional and governmental involvement in crypto?
I don't think that there's any other way around it. Sure, somebody can say, well, let's just keep the government out of it, period. We were doing well without Trump and the current administration. They think they're doing all these great things for the industry, but really they're just making things more centralized. We were doing just fine without them. But reality is, if you want an industry to mature, whether it's AI, whether it's internet, do we want more adoption? Well, you can't really do it without some type of government interference, right? And so you got to pick and choose your battles here. Well, let's move away from the stablecoin conversation for once here, Mike, and let's talk about GameStop, which is a meme stock. They've been struggling, and now they're thinking, okay, why don't we try to incorporate what MicroStrategy is doing? And so, so far not as successful as they would have thought, but it's still early, right? This is just like an initial reaction. Time will tell, and especially once Bitcoin starts doing better. Perhaps it does mean that GameStop will rebound. But what do you make of this story, Mike?
I think it's a Hail Mary, and it doesn't. And I think a lot of other people seem to think it's a Hail Mary, right? Like they wanted to issue 1.3 billion in convertible senior notes through a private offering. Initially, the announcement boosted their stock by like 10%, but then absolutely plunged by more than 25%. So I just think that they just see this, some investors just see this as just a copycat move, a Hail Mary move, and it's my guess it's likely to fail.
I thought this was pretty ironic, Mike. Say Foundation, which is obviously a blockchain network, they're trying to acquire 23andMe. Like, how ironic is that a Web3 company is acquiring a Web2 company to try to save them?
It is pretty interesting, and you've got Justin Barlow's post up there. He's the head of investments at Say Foundation, and I know Justin well. So what makes sense is that Say has been very dedicated to the DeSci space. They've dedicated a $65 million VC fund, and this was this is sometime last year, dedicated to DeSci startups building on the same network. So that aligns very, very well with this 2023 potential 23andMe purchase. And a lot of what we've spoken about as one of the use cases for blockchain and crypto is just ownership, right? User data ownership of our user data, being able to decide how my data is used and potentially monetize my data. So this is a pretty awesome initiative, I think, from the Safe Foundation that really really aligns with their direction and their belief in DeSci.
If you look at the investment that when Trump first became president, you remember that big, large AI infrastructure investment. SoftBank was part of that, I believe. From what I recall, AI in terms of science was a focal point. So how we love in crypto, we love taking things that are happening in the traditional world and just like really hyping it up in crypto, right? So I do see a narrative for DeSci, especially once the market rebounds. So that's kind of like a, I guess, hot take, bold prediction, but obviously not financial advice.
So a lot of the DeSci activity has been focused on essentially crowdfunding of drug discovery and drug development. And so I think there are some issues, with that, just in terms of like the amount of money that can be raised, the understanding of how these processes work, how drug development works, how important getting drugs through the FDA approval process is to the success of the drug. And then also just like the market dynamics around that. And but I think just like using crypto one as like capital formation, just how great crypto is for capital formation, it just makes a lot of sense there. But I think this being more of a data play, I think that's again another great use case for blockchain is ownership of data, control over the use of that data. And I think that is a pretty that's a pretty clear use case, and I think that could be a really good fit here.
Hyperliquid gets exploited. So a trader gamed the liquidation system and walked away with $6.26 million, Mike, until Hyperliquid froze the account and then pretty much nuked the market. So this raised a question, how decentralized is Hyperliquid? I mean, what do you make of this story?
I can't speak to kind of the mechanics of what this trader did and that exploit, but I think what was interesting was how quickly Hyperliquid responded and how they delisted Jelly, which was the token that the trader used to create this exploit. And it essentially said, Hyperliquid was this, no VC funding, highly decentralized perpetual DEX that had a great launch, and it's a great product, and people were just saying that this is the decentralized future for perpetual DEXs, and maybe a little that is in doubt now in terms of how quickly they were able to react to this by essentially making having the decentralized team make these moves. And decentralization is a spectrum. I think it just really depends on how you communicate how decentralized you are. I think it's everyone is going to nitpick at how decentralized you are. But can you blame a team for moving quickly in kind of a centralized manner to kind of save some money for their users? It's hard. It's just one of the really difficult aspects of running a crypto protocol. So
the other part of this story, Mike, is so Hyperliquid delisted Jelly because they were trying to basically save themselves. Meanwhile, you had centralized exchanges that started listing Jelly to essentially drive Hyperliquid just out of existence.
Yeah. What are your thoughts on that
dirty.
part? That's dirty too. That's dirty. It's P2P out there, man. Like, you know, because it's obviously, Hyperliquid took a lot of volume away from some of these the sexes that work. So yeah, it's rough out there. It's true P2P stuff right there.
Meanwhile, when Bybit had their exploit, everybody, all the sexes were coming together and trying to help them out. So it's just a very interesting dynamic, right? How when it's Hyperliquid, they didn't get the support, but when it's Bybit, it's like everybody comes together and helps out. So just an observation that I think a lot of people in the industry are making about that. It's just interesting.
That's a good point.
So moving on, Mike, you bring to me 3 different projects that secure funding, and this is always a great way for us to tell where are we headed from a tech perspective, from a narrative perspective. And this week we've got startups that are raising 2.5, 3.14 million, even $24.5 million. So we're going to jump right into it, Mike. Let's start with DCharge. What are they about?
Yeah, DePIN, right? So it's a decentralized EV charging network. They raised $2.5 million in a seed round led by Lenders Cap with participation from Daedalus, Coliseum, and a couple of other VC firms. So they essentially are bootstrapping an EV charge point network. So they by combining the hardware, IoT-enabled devices, with blockchain and their crypto, which is Charge, I believe. So essentially, property owners can earn passive income by hosting charging stations, right? It is just like we've seen so many other times that we've talked about so many other times. It's using crypto to incentivize human behavior to bootstrap a network faster than can be done ever before. And it's just they've deployed 151 EV chargers, provided over 21,000 minutes of charging so far. And they're still really early. They're still just getting started. But yeah, instead of having Tesla put their superchargers everywhere, or we've got an electric vehicle, we use EVgo. It's now people with homes can kind of install one of their chargers, get paid in charge tokens, and essentially bootstrap a much larger network, and likely charge lower fees to the EV owners who want to start charging the network. So just another kind of quintessential use case of crypto as an incentive to bootstrap networks faster and cheaper than ever before.
Next is CapX AI. They secured 3.14 million, Mike.
I think about this. I wonder, I wonder if Pi has anything to do with the 3.14 million here, but I don't know. Just a random thought. But it's
starting a conspiracy.
Yeah. So CapX AI, they're Ethereum L2 for AI agents. Like a few AI crypto to AI protocols we talked about before, they enable the development, ownership. But what's interesting is also the trading of AI agents. So there's a couple of components to it. There's CapX Cloud, which is a decentralized network for hosting these AI applications. The CapX chain for building and trading AI agents, and the CapX Super App for discovering and interacting with these AI agents. But going back to that trading of agents, I think that's what I haven't really seen too much. Usually, a lot of the other agent protocols are spinning up agents and then linking a token to them. But this one is kind of the ability to trade AI agents, and again, it's like crypto. It allows you to make a market out of anything. So not only can you create an agent with CapX AI, if there's something that is if you create something that is super valuable, and you can now kind of make a market out of that agent. So pretty cool.
Mike, next we have Rain, which secured 24.5 million. This is the highest out of the 3 that we're going to discuss today. But there's solving a very interesting problem from what I understand. A lot of teams in Web3 that I talk to, like ecosystems, like whenever they have like BDs or people traveling conferences, they don't really have a way to expense their flight or just groceries, whatever it is that they're doing, because like in the traditional world, you have like a corporate card. So this is essentially kind of like that, except for crypto. Is that right?
Yeah, and it allows. So not only that, but allows them to spend on-chain assets. So, I think we are, a lot of these protocols have, have crypto assets in their treasury, whether it's USDC, USDT, or their token. Rain allows these teams to spend on-chain assets. Like you mentioned, they raised 24.5 in a round led by Norwest Venture Partners, which is a kind of big traditional tech firm, VC firm. Galaxy Digital is involved, Lightspeed, and a few others. So yeah, I think there's a trend of spending crypto assets in the real world. And Rain is coming at it from a kind of ecosystem, crypto native organization. But I think you're seeing it more in retail. You're seeing it more for other organizations as well. So, and I think that's a great move. It's just kind of like one of these things where crypto is just in the background. You use a product like you use any other product, like any other corporate credit card, but crypto's in the background. It's the asset actually being spent, but then seamlessly swapped to USD. So yeah, I think we're going to see a lot, and that's kind of what we're going for, right? Like just having blockchain crypto in the background without having to deal with doing cross chain transfers and all that, and then exchanges and swaps and.
Yeah, stablecoins continue to make the headlines right now. That's the narrative. What we mentioned it at the beginning of the show, Mike, and we're going to end it this way. Thanks so much, Mike. We learned a lot today. And for those that are watching, if you learned a lot, please subscribe to the channel, like the video, give Mike a follow on X, and we'll catch you guys in the next one.
See you, everyone.